Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, August 26th at 2 p.m. in London. For much of the last 12 years, the question of whether to hold cash in a portfolio was really a question of negativity. After all, for most of that time, holding cash yielded nothing, or less than nothing for those in Europe. Holding it implied you believed almost every other investment option was worse than this low bar. Unsurprisingly, the low returns offered by cash over this period led to low returns. For 8 of the 10 years from 2010 through 2020, holding cash underperformed both U.S. stocks and U.S. Treasuries. And while cash has often lagged stocks and bonds over time, the returns to holding cash since 2010 were historically bad. But that's now changing because cash no longer yields nothing. As central banks have raced to raise rates in the face of high inflation, the return on holding cash or near cash investments has jumped materially. 1 year ago, a 6-month U.S. Treasury bill yielded 0.04%. It now yields 3.25%. That is 3.25% for an investment with very low volatility backed by the full faith and credit of the U.S. government. That's a higher yield than a U.S. 10-year Treasury bond. It is more than double the dividend yield of the S&P 500 stock index, and it's just 0.25 percentage point less than the dividend yield on U.S. real estate investment trusts. It's important to note that not all short-term liquid investments are created equal. While 6-month U.S. T-bills now yield 3.25%, the average yield on 6-month bank CDs is less than 1%, and the average U.S. savings account yields just 0.2%. In other words, it pays to shop around. And for those in the business of managing money market and liquidity funds, we think this is a good time to add value and grow assets. What are the market implications? For equity markets, if investors can now receive higher yields on low-risk cash, we think it's reasonable to think that that should lead investors to ask for higher returns elsewhere, which should lower valuations on stocks. My colleague Michael Wilson, Morgan Stanley's Chief Investment Officer and Chief U.S. Equity Strategist, sees poor risk-reward for U.S. equities at current levels. More broadly, we think it supports holding more U.S. dollar cash in a portfolio. That's true for U.S. investors, but also globally, as we forecast the U.S. dollar to continue to strengthen. Holding cash isn't necessarily a sign of caution. It may simply be efficient allocation to an asset that has recently seen a major jump in yield. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.